Hello, everyone. My name is Nathan Corey from Richardson Capital Management, and I'm joined today by Dan Brown, our Director of Investment Management. And we're here today for the Economic and Investment Update for the month of October 2022. Dan, after a couple of sharp negative months in August and September in the broader financial markets, we actually saw some strong performance in the month of October, with most of that coming in the last 2 weeks of the month or so. Do you want to start by giving us just a little bit of a backdrop on that performance and what some of the drivers were?
Yeah, sure, Nathan. So to start off the month of October, we actually saw many stock indexes making a new year-to-date low. And then investors picked up on the fact that they sensed anyway from a couple of Fed speakers that they might be changing their tone as far as the pace of future interest rate hikes. So a couple of Fed speakers cited the effects of a lagged effect for monetary policy, meaning that it takes its time to work its way through the system. So again, investors reacted very positively to this and pushed stocks quite a bit higher for the month of October. But we would kind of regard this as a bear market rally, similar to what we saw from mid-July through mid-August, where stocks were rallied but then gave back a lot of those gains.
Thanks, Dan. And Dan, while we saw strong performance on the equity markets, we continue to see weak performance in the fixed income markets. Now, obviously, this year, the key issue has been inflation and the impact of inflation on the markets and the Fed's raising rates and what that does to the markets. While we didn't have a Fed meeting in the month of October, we still have that inflation issue as kind of the core issue going on. Do you want to give a little bit more color on what kind of drove the negative performance of the fixed income markets over the month?
Yeah, we still see interest rates, grinding higher slowly throughout the course of the year. So, for example, the U.S. 10-year security, Treasury security, peaked, mid-month around 4.22%. So again, that was a year-to-date high. Interest rates did back down a little bit towards the end of the month, but again, it's the story that we've seen pretty much all year of rising interest rates. And why are interest rates rising? Primarily because the Federal Reserve continues to raise interest rates. So we're thinking that at the next Fed meeting, November 2nd, that we'll see another 0.75% interest rate increase. And then probably for December, maybe not 75 basis points, but maybe 0.5% for sure.
So Dan, despite the fact that we've seen some positive performance in equities for the month of October, we're still looking at a pretty sharp sell-off for the year-to-date returns on equities. And what's unique about this time is that we're seeing that at the same time as those negative returns in fixed income that we talked about. How rare is this environment where we're actually seeing declines on both of those asset classes?
Yeah, Nathan, it's actually very rare. In fact, it's the only time that we can find in modern financial times where this has occurred. And the only other time that we've seen this previously is 1931. So again, it's very rare. And again, just to recap what we talked about earlier, fixed income is selling off or generating negative returns due to the very rapid rise in interest rates over the course of the year. So the main takeaway of this slide is just to emphasize that it's been a really challenging year everywhere in the financial markets, not just for stocks and fixed income, but other asset classes, even safe haven asset classes like gold are negative for the year.
And Dan, toward the end of the month of October, we had the release of the GDP results for the third quarter, which showed a positive growth rate of 2.6%. While a lot of investors might look at that positive GDP growth as a sign that we might avoid a deep recession, when we actually look underneath those figures and kind of see some of the underlying trends, it might not look as promising. You want to give a little bit of insight on kind of what we're seeing there?
Sure, Nathan. So again, the headline figure for GDP was positive, which was nice after seeing 2 consecutive quarters of contraction in the economy. But again, when we look into the components, they're a little bit troubling. So first and foremost is on the housing side. So I think everyone's aware that mortgage rates have risen dramatically over the course of the year since the Fed started their interest rate hiking campaign. And that's hurt housing quite a bit from an activity standpoint. And we would expect that would slow probably a little bit further into next year as the Fed continues to hike interest rates and mortgage rates stay high. And then secondly, we noticed that consumer spending, which is the largest portion of GDP, also continues to slow. So the consumer's still spending, but the other troubling sign that we notice on the consumer side is those balances that were built up from the government stimulus checks that were sent out in 2020, 2021. Those reserves are starting to shrink. So again, we think that consumer spending is set to slow a little bit further. But to recap, where does this leave us on GDP and thinking about the Fed meeting? We still think the Fed's going to raise by 3/4 of a point when they meet in early November.
So Dan, given those ongoing issues of persistent inflation, the Fed interest rate cycle, and some weakness that we saw in the GDP figures, it seems safe to say that we would expect this volatility that we've been seeing to continue for some time, probably through the end of the year and maybe into next. What does that mean for the positioning of our portfolios going forward?
Sure, Nathan. So we expect the volatility to continue at least into the end of this year because inflation is expected to remain stubbornly high, and this leads the Fed into tightening monetary policy. So again, we talked about a November increase in Fed funds, and we also expect a fairly sizable increase in December. And then we'll just have to wait and see where we are with inflation when we begin the new year. So the recent strength that we saw in the equity markets, most recently in October, and then also July, August, led us to de-risk our portfolios twice in the last couple of months here. And mainly when we de-risked, we took 3 to 4% out of stocks and put that into more conservative assets. Most recently in money market. So for the first time in many years, investors are being paid a very attractive rate compared to what it was in the years leading up to the most recent rise in rates early in the year.
Great, thanks Dan. And with that, we'd like to thank you all for watching. Hope you find value in these videos, and as always, feel free to share with others that you think might find value in them. Thank you.